This is Town of Monroe Pension Committee and OPEB Board of Trustees joint meeting agenda, special meeting Thursday, April 27th, 6 p.m. Please note the meeting will be recorded and made available on the town's website pursuant to state law. If any meeting or anybody attending remotely, please remember to mute your microphone unless you're speaking. Anybody participating remotely should state their name and title, if applicable, at the outset of each occasion the person is speaking. All votes taken during which any member of this body are participating remotely shall be taken by roll call unless the vote is unanimous. The chat feature will not be utilized during or considered during this meeting. So we officially called to order. We have Steve Kirsch.
Present.
Frank Duchess.
Here.
Jonathan Formicello. Jonathan. Ken Kellogg.
I'm here.
Joe Cobsa.
Here.
Jason Maurer.
Present.
Dennis Condon.
Here.
Ron Bonofsky.
I am here.
And I can't see his Heidi there. So,
I'm here.
all right. I think that's all. And we have Devin, of course.
Mike.
Who do I miss?
On pension, Chrissy Martinez, Board of Ed.
Thank you. Sorry about that.
She's here in the room. And then for OPEB, you have Chairman of the Police Commission, Mike Vitello, who I don't know is
Sorry,
on.
Mike.
I don't know if he's on the
Mike
phone
there?
or not. He's not here. I don't know if he's on the phone or not. I'm guessing not.
I'm guessing not, since we're not hearing from him. So we'll mark
All
them
right.
right now. Absolutely. And Devin, let's start with the review of the minutes for pension. We have voting record of January 23rd.
Thanks, Steve Kirsch. I'll make a motion to approve the minutes and voting record of January 26, 2023 regular meeting and February 16, 2023 special meeting of the Pension Committee.
Okay.
Ken Kellogg,
Seconded.
Do we have any
Jason Maurer.
discussion? Thank you, Jason. Any discussion, questions, comments? Hearing none. Any opposed? We pass unanimously. And we have the
The pension.
OPEB. Yeah.
I'll make a motion
for
to
that.
approve the minutes for the OPEB Board of Trustees.
I'll second.
Second. Thank you. Any discussion? Hearing none. Any opposed? Okay, passed unanimously. New business quarterly investment review. Devin, we are with you.
Okay, good to see everyone. Thanks for having me. If someone in the host room could give me screen sharing capabilities, that would be excellent.
You should already have it, Devin.
Oh, okay. I didn't when I first logged on, but you're right. It's looking good now. Great. My mouse is being a little bit wacky, so. All right, so can everyone see the cover page, Town of Monroe Quarterly Investment Review?
Yes.
Yes.
Okay, great. Let me just make a couple adjustments so I can still see the tiles of everyone's faces. Okay, so as per usual, we'll start off with the governance calendar. And this quarter, we have a focus on portfolio expenses. So in every quarterly report, we do have an analysis of the underlying investment fees that are paid. But on an annual basis, we also bring in custodial fees and fiducians fee, just so that everyone is up to speed on the all-in fees that are being absorbed by the plans. And you do see on this page liquidity review. We only provide a liquidity review for those clients that have strategies that are not liquid. So whether it's private equity, which are completely illiquid, or something like a hedge fund, which has limited liquidity, we'll provide that analysis. You know, X% of your portfolio offers daily liquidity, Y% offers semi-annual, so on and so forth. In the Town of Monroe's portfolios, everything is all of the strategies are accessed via institutional mutual funds. So everything offers daily liquidity. So the entire portfolio is liquid on a daily basis. So if we look, why is this doing? Okay, there we go. So here on page 6, we have the all-in fee review. So again, investment management fees, these can be found in every quarterly report. But for the town and the Board of Ed pension plan, those investment management fees come in at a weighted average of 47 basis points or 0.47%. The OPEB plan, as you'll remember, uses only passive strategies. So when we have all index funds, that tends to be much less expensive. The weighted average fee for the OPEB is only 7 basis points or 0.07%. Custodial fees that are charged by principal come in at 3 basis points. And there is a minimum annual fee. So across the asset-based fee and then the per account fees, principal requires a minimum annual of 10,000 be met. And because the asset base doesn't quite get you up to that $10,000 minimum, the minimum does come into play. So you pay principal just over 3 basis points or $10,000 per year. And then fiducian's fee is a flat dollar fee that's subject to a 3% escalator. So I think when we first started out, it was a flat $35,000 fee. The escalator has come into play. And so now the average fees that were paid over the course of 2022 work out to about $41,000. And if we were to translate that into basis points, that would be an average of about 13 basis points. So if you think about for the two pension plans, 47 basis points for investment management fees, about 3, a little bit more for custodial fees, that brings you to 50, and then you have 13 basis points for fiducian's fee. So all in, you're looking at a weighted average expense of about 63 basis points or 0.63%. And that is for the two pension plans. The OPEB plan is much lower because of the use of index funds. So the OPEB plan is included in the custodial costs. So you're looking at just north of 20 basis points or so when we factor in the fiducian fees and the custodial fees and the investment management fees. Any questions about any of that so far? Okay, so just a quick snapshot of valuations. When we compare the 2020 valuation reports to the 2022 reports, you can see that there was an improvement in funded status for both the town plan and the Board of Ed plan. So we are just shy of 100% funded as of the 2022 valuation report. And the actuarial return assumption that's being used is 6.75%. So, we've discussed over the years, and there is a quarter that has comparative results for other municipalities across the state of Connecticut. So the town of Monroe's funded status is much healthier than the average pension plan in the state of Connecticut. And your actuarial return assumption that's being used, that 6.75%, is right around the average across the state of Connecticut. So your plan looks very healthy from a funded status perspective, and we do feel that you're using a reasonable return assumption. Just a reminder that last quarter in the governance calendar, we went through our exercise of doing an asset allocation modeling study. And so that projected out forward-looking returns and, kind of told us the likelihood of you meeting that 6.75% return objective. And given your asset allocation profile, this return assumption is completely justifiable. It's perfectly reasonable. We don't think that, you need to really hammer home any significant changes. And then if we look at the funded status of the OPEB plan, the funded status has jumped quite significantly from the 2020 report to the 2022 report. And that plan is using an actuarial return assumption of 6.5%. Obviously, assets are much lower. This is a much smaller plan than the two pension plans. So I'll take a pause. I'll bring the screen down for just a moment. Are there any questions on anything within the governance calendar?
One quick question on the funded ratio, so we're much better than average. What's the average? On the funded ratios for both.
I'm sorry, could you repeat that one more time?
Funded ratios were 98.7 and 97.4. You said we're much better than average.
Yes.
What is the average?
Oh, average is about 75%.
Thank you.
Yep, you're welcome. Any other questions? Okay, great. So let me dive ahead and bring up the capital market slides. And, you know, it was pretty interesting. We came into the year with a lot of anxiety already embedded within the market. So we had anxiety over the Fed's continued rate hike campaign. We had continued high inflation. So folks were concerned about that, fears of a recession. And then, oh, why don't we just throw a bank crisis in on top of all of it and see how we fare? So, you know, certainly there was a lot of volatility throughout the quarter. And if you'll remember, when we had our meeting in January, we talked about the three themes that we saw driving the markets for the coming year. And the first theme was persistent volatility. So certainly that did come to pass. We saw continued volatility throughout the course of the quarter. The second theme was moderating inflation. Our expectation was that inflation would continue to come down, and that too has come to pass. And then the third theme was bear market bottom. So it was the expectation that, you know, whether we hit the bear market in October of last year, which is as of right now, what the lowest, you know, print of the market was, or if we're to reach another low at some point in the coming months, the expectation is that we'd be climbing our way out of this difficult market environment at some point this year. So we could, you know, safely say that the bear market is behind us. So those were our three themes for 2023. On the volatility front, we certainly saw a lot of volatility, and the bank crisis certainly did you know, push that and enhance that. And I think that that's kind of cleverly illustrated on the top right-hand side of page 10 with this chart. So the numbers in this chart don't really matter. But what this is showing you is when we ended 2022, this royal blue bell curve represented expectations for the Fed funds rate at the end of this calendar year. So it was asking folks to project out, okay, at the end of the next year, where do you think the Fed funds rate will shake out? And, you know, most people tended to think between 4.5 and 4 3/4. Then we got an inflation report that had perhaps not receded quite as much, and we had a really strong labor report indicating that the labor markets were still very strong, so that the Fed rate hike campaign had not had as much of an impact as perhaps had been expected. So you saw those expectations move very significantly to the right, where most folks, instead of expecting a 4.5% Fed funds rate, were expecting a 5.5% Fed funds rate by the end of the year. So these data points are captured as of March 8th, which was the day before the news broke about Silicon Valley Bank. When that news broke, then everything shifted sharply to the left. So you see kind of a repricing of expectations. This was investors' expectations as of a week after the Silicon Valley Bank news, where the expectation was that the Fed funds rate at the end of the year would be much lower, that the Fed would actually perhaps begin cutting rates instead of continuing to raise rates. So, you know, this just goes to show you how significantly expectations were shifting throughout the course of the quarter, and even, you know, sometimes in the case of just 1 week. And ultimately, towards the end of the quarter, they shook out right around here. which is a Fed funds rate at the end of this year of somewhere in the 4.25 neighborhood. So again, it's not so much the numbers that matter, it's the significant shifting of these market expectations. And, you know, when you have investors that are kind of being whipsawed back and forth by these news, it does create some consternation in the markets. So we certainly saw volatility on the heels of that. Regarding the second theme of moderating inflation, and I did point out when we talked about the market themes that it was not our expectation that inflation would come all the way down to the Fed's target of 2%, but simply that we'd see a downward trajectory. And I think it's kind of interesting on the bottom left-hand side where we show the 12-month CPI figure, which is, you know, the figure that's captured in the news. This was printed as of, I think this was the January reading, so we didn't have the later readings that actually continued to come down. So 5% CPI is the most recent reading that we've seen. But what I think is really important is if you truncate that time period and look only at the most recent 6 months rather than the last 12 months, the inflation rate is much lower. It's actually only 3.2%. So that goes to show you that, you know, that pretty high level of, you know, 5 to 6% is factoring in a 6-month period where we had quite high inflation. Inflation peaked last summer at over 9%. If we lop off those first 6 months of the period and look only at the most recent 6 months, inflation has come down much more substantially. So this should indicate that the Fed's rate hike campaign has been working, that, you know, the supply chain issues that have been resolved are now, you know, you're seeing that resolution come into those inflation numbers, and we should continue to see that broader inflation print come down. Any questions so far? Okay. So if we look at page 11, I did mention that we continued to see strength in the labor markets, which you would think is good news. But again, that does create some anxiety because then folks are worried that the Fed will continue to hike rates. One of the things that has been beneficial for diversified portfolios, and your portfolio specifically, has been the weakening of the US dollar. So we've been really in a 10-year time period where the dollar has continued to strengthen relative to other currencies. And while, you know, you may think that that's good news for investors, and it can be, it's not good news when we look at the impact on international equities. We have seen the dollar fall, so that started to happen in the fourth quarter of last year. It continued throughout the first quarter, and that's really been a tailwind for international equities. So when we look at some of the specific asset class returns, you'll see that international markets, particularly international developed markets, actually outperformed US markets in the first quarter, and in part that was due to the weakening dollar. It also was in part due to the fact that the winter in Europe was not nearly as harsh as what folks were expecting. So high energy prices didn't have as much of an impact on the European economy as people were expecting. And then the other thing that I'll mention about page 11 is simply that investors are now expecting that we will see negative earnings growth. So all of the contraction that we saw last year was due to price compression, where stock prices were coming down, but we weren't really seeing it reflected in the earnings results. Now we are starting to see some earnings contraction. The good news about that is that typically when we have a market cycle, a period of a downturn, that market downturn tends to be led on the front end by multiple compression or price compression. And then the last part of the cycle tends to be that earnings compression. So now we're seeing that earnings compression come to light. That should signal that we are towards the end of this bear market, and hopefully we'll be working our way out of it in the coming months, or perhaps we're already on our way up. So page 12 just gives us a snapshot of all of the asset class results throughout the course of the quarter. So despite all the volatility, despite the consternation and the anxiety in the markets, you actually saw really positive results basically everywhere in the investable universe, with the one exception of commodities. And you may remember that commodities were the only area of the market that was positive last year. So it's all right, they're giving a little bit back, but everything else, fixed income, US equities, international equities, other real assets, hedge funds, everything else was positive in the course of the quarter. And I mentioned that the falling dollar was beneficial for international markets. You can see that international developed equities were the strongest performers in the quarter, up 8.5%. So despite all the headline noise, really quite a strong quarter, strong start to the year across the investable universe. That being said, I'm going to scooch ahead to the eye test. Page 19 with the minuscule font does show us longer term results of all of the market indices. And if you look at the 1 year column, you can see that despite the fact that we're now coming off of 2 quarters of consecutive positive returns in most areas of the investable universe, you still do see quite negative results on a 1 year basis. So for instance, the aggregate index, the broad fixed income index, down almost 5% on a 1 year. And again, just to refresh your memory, when you have rising interest rates, which is the type of environment that we've been in over the course of the last year, that means you have falling bond prices. So the rising interest rate environment that we found ourselves in last year was a real headwind for fixed income markets. And despite the fact that you saw the ag return 3% in the first quarter of this year, you're still looking at negative results on a 1 year basis. And then the S&P down 7.7% on a 1 year basis. Small cap stocks, as measured by the Russell 2000, down 11.6% on a 1 year basis. So you're still really feeling the effects of the 2022 downturn in those 1 year results. But on a positive note, the 3 year record is fantastic. Look across the equity universe and you have double-digit returns everywhere, with the one exception of emerging markets, which is up almost 8% annualized over the past 3 years. So that's nothing to shake a stick at, and everything else is up double digits, and in some cases more than 20 percentage points for some of the value indices. So the longer term results really across the investable universe remain very strong, but the past year has been a challenge. So I'll take the screen down, I'll pause, ask if there are any questions or any market commentary that you want me to dive into in more detail.
Yeah, Devin, just for a second, can you just speak a little bit to where we think the dollar is going to be heading? Because again, a lot of conversation being in Asia for the last week that, you know, rates here have not ticked up nearly as much as in the US.
Right.
And there's certainly going to be some, you know, cross-border changing going on because of the, you know, the flight of money currency. You know, rates are still in the 2 to 3 range here in Asia.
Right.
And I don't really know how that's going to affect the market and the dollar and all. I mean, there's a lot of moving pieces to this, but not everything is moving in unison across the globe by any means.
Exactly. Right. Yeah. And there's a lot of noise in those current, you know, I think currency is particularly hard to call shorter term. So we think it's likely that the dollar will either continue to weaken or at least won't strengthen fairly long term. So, you know, what we observe are the market cycles, and you tend to see pretty protracted periods of relative outperformance compared to other currencies, and then, you know, relative weakness. And we think that we've probably embarked upon a period where the dollar is going to be weaker. But that's more of a long-term outlook. We definitely don't have a short-term view of how the dollar will perform relative to other currencies. And, you know, that's why frankly, that's one of the reasons why we have diversification in the portfolio. And, we've always got exposure to international markets. We always have had exposure to international markets. If the dollar weakens, yes, that will be a tailwind for international equities, but that's also not the only reason to own them. So I wouldn't say, we definitely don't have a distinct view on currency, and we also don't use a currency outlook as a reason to invest in a certain area or to skip a certain, you know what I mean? So it's not a
No,
very
I understand. I mean,
specified
it's challenging, but yeah, it's
Yeah.
unusual times. I don't know that we've seen these kind of interest rate environments in, decades. So,
yeah, definitely.
and we really had stable currencies for quite a long time as well, or relationships at least. So I just think we might go back to some volatility in currencies, which tends to make big money move into other markets.
Yeah,
So you could
Yeah,
see some of those
it's-
currency plays coming into effect.
yeah, it'll be interesting to see how that plays out. Good question.
Yes.
Interesting to put it mildly,
Interesting
especially
times,
for
as they
you
say.
who, you're in the field.
No, it's just interesting that commentary to get from some of a couple of different people, trying to figure out where the world's going. So
Great,
thank you.
good question. Any other questions on the capital markets? Okay. I'll go ahead and bring the screen up and we can dive into the portfolio review. So as you'll remember, the town plan and the Board of Ed plan have almost the exact same asset base. They have the same underlying asset allocation profile and the same underlying managers. So we'll kind of use the town as the proxy for both pension plans. Here on page 21 is what we call the dashboard. This kind of captures all of the relevant information. So if we start on the top right-hand side, this is the account reconciliation. So you can see that we ended the quarter. Oh, sorry, my dog is banging at the door. Hold on one second.
Much more important.
She's
So
very
Michael, coming
demanding.
back.
So we ended the quarter with an asset value of 13.63 million. And if you look at the asset allocation profile compared to the targets on the bottom right-hand side, we're just about in line with the targets. And just as a refresher, what we do is we raise sufficient cash to cover 3 months worth of disbursements. And the vast majority of those disbursements are monthly pension payments. So what we will do is use those cash raises as an opportunity to rebalance if the portfolio has gotten out of alignment with the target allocation. So you'll see it's pretty closely aligned, and that's because of that, kind of organic rebalancing process that happens. So we've got a 25% target to fixed income, 41% to domestic equity, 29% to international equity, and then 5% to real assets. This is slightly different from how we started the calendar year. So you may remember that when we had the special meeting, we voted on a couple slight allocation changes where we brought the domestic equity from 39% to 41%. And we actually, I believe the international equity stayed the same, but we brought down the real assets exposure from 7.5% to 5%. So we did reduce that diversified real assets exposure. We slightly increased domestic equity. And if we look at performance, so again, it was a good quarter for the markets. The portfolio was up 5.5%, just slightly outperforming its blended benchmark. And then on a fiscal year-to-date basis, so if we look over the past 3 quarters, you're actually at 6.7%. So pretty strong return over the last 9 months. But then you look at the last year and you have that dip in the performance. So down 5.7% over the last year. I will point out that although a negative return of 5.7 is certainly nothing to celebrate, you did outperform the blended benchmark. So compared to the benchmark, the portfolio did not lose as much as would have been expected. And that's simply because the active managers within the portfolio outperformed. And you do see that similar outperformance on a 3-year annualized basis. So the portfolio is up 10.6% per year over the last 3 years, even despite the struggles over the last 1 year. So that's a pretty strong return, and again, ahead of the blended benchmark. If we go back to since inception, the return is more modest, only about 5.1%. So if we hearken back to the return objectives, which is, ties in with the actuarial return assumption, and that's at 6.75%. You certainly have achieved that 6.75% and then some over the past 3 years. But going back to the inception in 2015, so almost 8 years, you have fallen a bit short of that. And, that's simply, let's see if we have calendar year results here. We have had a couple of disappointing years. 2022 obviously was a painful year. 2018 we had negative results, and then 2015 when we first started, we don't have the full calendar year, but that was a tough year in the markets as well. So those adverse market environments have had an impact on the longer term number. So that's why you're clocking in at 5.1%. So if we take a look at the portfolio, I'll just make a few more comments and then certainly open to any questions or questions at any time. So please feel free to interrupt me. But on page 23, you'll see the portfolio allocation as of the end of March. So again, we were at 13.635 million. And you'll see all of the underlying investment strategies. Remember that we did make a few underlying changes to the fixed income managers. So we introduced an allocation to TIPS, Treasury Inflation Protected Securities. So that's a new allocation, very small, only 1.5% target, but we did add that to the portfolio. We reduced the exposure to the BlackRock Strategic Income Opportunities Fund. And so that, I believe, had been at 9%, and we brought that down to 5%. And just a reminder of the rationale behind that, the BlackRock fund was a very defensively positioned fund, tended to have a shorter duration profile. And given the fact that we felt that we were towards the end of the Fed's rate hike campaign, and interest rates had increased so substantially that traditional bond strategies were actually offering a very attractive return, and there wasn't the need to be quite as defensive. So that's why we reduced the exposure to BlackRock, even though we continue to very much like the strategy. And it's actually been one of the drivers of relative outperformance over the past couple of years. But we did decrease that exposure and increase the exposure to MetWest and Baird, which are the more traditional fixed income strategies. And then finally, we replaced your global bond manager. So we had the PGIM, Global Total Return Strategy, in the portfolio. They had experienced not only poor performance, but also a lot of investment team turnover. And that was something that we were concerned about. So you may remember that last quarter, I presented a manager search. We recommended the Dodge & Cox Global Bond Fund, and that is what has been put into the portfolio. On the domestic equity side, the bulk of the exposure is passive via the Vanguard 500 Index Fund, but then we do have active SMID cap value and SMID cap growth. So Diamond Hill is a value manager. It's got exposure to both small and mid cap. Conestoga is the growth manager, again, both small and mid cap. And then on the international equity side, we've got 2 managers that are focused in the developed markets. Dodge & Cox, which is more of a value approach, and MFS, which is more of a growth style. And then we have Harding Loevner on the emerging market side. And then finally, we do have that diversified real assets exposure. So just as a reminder, the real assets fund has exposure to TIPS, commodities, natural resource equities, infrastructure, and real estate. So kind of an all-in-one solution within the real asset space. So if we look under the hood and take a look at some of the asset class performance, if we look at the fiscal year and the 1-year column, you'll see that the fixed income managers collectively have outperformed. So fixed income managers fiscal year to date are up 1.1%, while the benchmark is down about 20 basis points. And on a 1-year basis, The fixed income managers collectively are down 3.8%, but not nearly as negative as the benchmark, which has been down 6.4%. So you've had some significant downside protection from the fixed income managers in the portfolio, and that's largely been driven by BlackRock. You can see a strong return stream compared to the other strategies in the portfolio, and outperformance on a longer term basis as well. If you look in the domestic equity section of the portfolio, up 9.5% fiscal year to date, down 8.2% on a 1 year, but up 17.7% on a 3-year basis. So we've got, again, most of that exposure is passive through the S&P 500 index fund. We do have Diamond Hill and Conestoga. Diamond Hill looks pretty good relative to its benchmark for most time periods. So you do see some relative outperformance compared to the Russell 2500 Value Index. And then Conestoga is a bit behind on a 3-year basis, but ahead on a 5-year basis, and certainly ahead since we've had it in the portfolio, which has been since early 2021. So the active small cap managers are doing their job. They are providing relative outperformance, although simply having had exposure to small and mid cap stocks over the past few years when large cap stocks have outperformed has been a little bit of a headwind. But long term, we think that that's the appropriate positioning. And in particular, when we find ourselves coming out of this market downturn, typically small cap stocks tend to lead the way when we have a market recovery. So we do expect those managers to provide some value. And then on the international equity side, our managers collectively are a bit behind the benchmark on a fiscal year to date basis, but very strong results in absolute terms, up 10.1%. So the international segment of the portfolio has outperformed the domestic equity segment of the portfolio for the fiscal year so far. And again, they've also outperformed on a 1-year basis, and you see your managers helping protect on the downside, down only 2.6%, whereas the benchmark is down 4.1%. So we're pleased to see that relative outperformance, although of course, you know, it would be nice to see a positive number. And then finally, the real assets exposure, that's down 10% over the past year, but up 13% per year over the past 3 years. So that annualized 3-year return is quite strong and above the real assets benchmark. So we do not have any recommendations to make any changes to the pension portfolios. All of the managers are in good standing. And again, we did just make some changes last quarter. I will mention that the Dodge and Cox strategy is on discuss status, and that's something that I mentioned when we actually presented them as the global bond solution that was on the table. They were placed on discuss because their director of fixed income is going to be retiring at the end of this year. So that's something that's been very well telegraphed. They've got a succession plan in place. It's nothing that we're particularly concerned about, but we do just keep an eye on that. So before we take a look at the OPEB plan, any questions about the pension plans? Okay.
No questions, but just a matter of housekeeping. I just want to note that Jonathan Formicella is and has been on the line. He's one of these. I see his number ending here in 59. He's having trouble unmuting himself. So
technical difficulties.
Reflect that he's present. Yes.
Okay. Perfect. Thank you.
He's not asking a lot of questions, which is good.
All right. So let me finish up with the OPEB. And if we scoot ahead to page 50, we ended the quarter with a value of the OPEB account of just shy of 2 million. So $1,956,606. You do see a gain, a market gain of 100,000 over the course of the quarter. So things are moving in the right direction. And if we look since inception, The portfolio started off at 700,000. That's going back to 2018. And you since have had contributions of almost $1 million. And those are net contributions. So you've probably put in more than $1 million and some has gone out the door. And then investment gains going back to the inception of just over 250,000 to bring you to that mark, just shy of 2 million. And if we look at the results, of course, because this portfolio is all passive, we would expect the return differential compared to the benchmark to be somewhat modest. So it'll, for the most part, just kind of be the benchmark return minus fees. So again, really strong performance for the quarter, up 5.4%. On a 1-year basis, down 7.1%, but annualized over the past 3 years, you're looking at a return of almost 9.5%. So performing as we would expect it to. And we can see all of the strategies here on page 54. They're also mentioned here on page 52. But page 54, we can also look at the performance. So on the fixed income side, we've got the Vanguard Total Bond Market Index. It's tracking the performance of the ag. On the domestic equity side, we have 2 strategies. We've got the Vanguard 500 Index Fund, which tracks the S&P 500. And then we have the Extended Market Fund, which is a small and mid-cap strategy. And then we've got on the international side, the Total International Stock Index that has exposure to both international developed as well as emerging markets. And then we have the Vanguard Real Estate Fund. So broad exposure, very similar allocation profile to the pension plans, a little more fixed income and a little less equity is present in this plan, but by and large, similar profile. So are there any questions about anything I have covered? All right, well, that was it for me. Happy to dig into anything if folks want to talk more, or if you want me to shut up, I'm happy to do that too.
Wow.
Anybody have any questions, anything before we let Devin go? Thought that was very well done. Thank you. Appreciate it. I know these are definitely challenging times and a lot of moving pieces. So I think this year is going to be a much more interesting conversations than we've had over the past couple.
I think you're right about that.
Not bad. Not bad.
No.
Devin, I'll ask one question if nobody else has one. Just to, at what point would you recommend we take another look at our investment assumption based on the fact that we're almost fully funded now?
That would be something that I'd want to talk to the folks at Hooker and Holcomb about. We see on the corporate pension side, once you hit fully funded status, you tend to have a glide path and make the portfolio much more conservative and kind of wind
correct, exactly.
We don't really see that as much on the pension side, because even if new participants are not coming into the plan, the life of the plan is still has a very long time horizon, because current participants are continuing to accrue benefits. So, we typically don't see a significant, reduction in the return assumption or change to the asset allocation profile due to the fact that you're fully funded. It's just kind of like it's just the benefit of not having to play as much catch up. It's just kind of maintaining. So unless the plan demographics change substantially, or if it gets to the point where current participants are no longer continuing to accrue benefits, then I think that would warrant a change. But other than that, I think that your return assumption of 6 3/4 is reasonable. And it's even more reasonable than it was a year ago, because right now,
because the rates are up.
For bond, exactly. The bond outlook is so much stronger. So I don't think that it's something that needs to be changed, but certainly we could have, you know, perhaps for a future meeting, we could invite the folks from Hooker and Holcomb to come, and we could just kind of have a discussion about whether there are any things that they think we should be thinking of from an actuarial perspective.
Yeah, I think that would be worthwhile, just because, you know, I'm thinking of it as, you know, if we did lower it and take advantage of the strength in our position right now, it gives you more flexibility going forward to not have to reach or allocate as risky and volatile markets, which, you know, certainly could be the next couple of years. So just the
Right.
thought process, but maybe we'll invite them to one of the meetings later this year.
Okay.
Okay.
All right. Well, good to see you all. Thank you for having
Always
me,
our pleasure.
and
Good to see
hope
you,
to see
Devin.
you soon.
Thank you.
All right. Bye-bye.
Thanks,
Thanks.
Devin.
Thank you.